I see a lot of the big name talking heads. They're saying that there's more room far down to go, which emboldens me because they're a good contrarian indicator because of the reason I spoke earlier. Everything they're talking is already priced in. They've already positioned themselves for this, so they're not going to put more money towards it. It is March 5th. It is a Thursday. And after I take you through the accounts, I want to update you on what's going on with the markets, um, why I think that most of this is already priced in, how everything I think is priced in, and why I made the moves I made, including a very, very big move on Apple, and why now. So here's the account. I'm sitting at, oh, can't see. All right, 82,000, down about a grand today, 1.21%, but it's much better than the markets. The markets actually went down quite a bit more, so 1.2 here, and if we go to the SPY, that would be a, oops, excuse me, SPY is down 3.32%, so quite a bit more. On the week, I think it's doing a little bit better, but on the 1 month, 3 month, and year, and so on, is doing quite a bit worse. You can see the month is down 9.3% and then 3.8, and I'm sitting at only down 4% instead of 9, and then 1.12 instead of 3.8. So doing pretty well so far to offset some of this down movement. Most of this is due to the fact that a lot of the positions are not necessarily correlated with the market. I have some foreign funds which are doing actually better than the U.S. market, surprisingly, in some parts of the world. Even though, if you think that the virus is one of the main causes for the sell-offs, you would think other parts of the world would be selling off more, but they're actually not. I think the main thought behind this is that because the U.S. markets are so overvalued in relative basis, those are the ones that are selling off. But Apple is actually outperforming the markets in this downturn, which is very strange. Usually Apple underperforms in a downturn and overperforms in the uptrend. But you'll see here, if you remember, it's just sitting about the same as the markets, are a little bit better actually on the 1 month, and is doing a lot better on the 3 months, and also doing better in the week. So it's outperforming the markets by a little bit, which is very strange. It's showing a lot of strength. And if you think about it, a lot of the news surrounding Apple, including the supply chain and all the store closure concerns and things, and already the guidance that they provided for their next quarter, is already priced into the stock because those are all known facts. So this could be as big as a downturn that we're going to see, excluding any kind of X factor that we still don't know about. Um, I think a lot of some of this relief rally as well that we saw in the last couple of days is perhaps due to the way things are unfolding in the elections. A lot of people were worried about, whether Bernie's going to win or whether Biden's going to win or who's going to face off against Trump. So a lot of the investors are, politically motivated because is going to affect the ways the markets function and the way which investments they end up going into. And on top of that, anytime you introduce change in the markets, uncertainty, people sell off because they're not sure, right? So whenever there's a change, it doesn't matter really what kind of regime is going in or out. If there's a change in regime, there's usually always a sell-off. And if you'll notice, if you don't believe me on that, you can just go back on 2000, when the Bush came in from Clinton. There was a big sell-off. When Obama took over from Bush, there was a big sell-off. And even when Trump became president, there was a big sell-off initially, at least for a day. There was a huge dip in the market, if you guys remember that. So whenever there's uncertainty, at some point the market usually always feels it. And if Trump remains, it's most likely that there's going to be even another relief rally from uncertainty. It's a very apolitical thing because it's the question is whether there's going to be a change or not, right? So that elevates the amount of uncertainty. So, all right, let's go in the browser again here. So Apple, what I've done here is I've actually sold a put. I've sold a put. It's down $210 so far, 5.65% of the position, but it's set to expire all the way in January 15th in 2021. So that's post election. So I think that with today's markets, because everything is executing so fast, I think that even if there is a change, it will resolve itself within a month or two because, as you can see in this downturn, we already had a big sell-off and we already had a big recovery, and it just all happened in a matter of days. And market usually takes into account the future, and now people are so good at calculating everything that they take the future into account like right away. They don't need a lot of time to mull over the information and make slow decisions. Nowadays, all the hedge fund managers and all the pension fund managers, everything, they have their scenarios already preset. So in case of this, we do this. In case of this, we do this. Like I've been watching recently some fund managers videos, and that's exactly their thought process, right? They're very guided by they have like rule-based investment strategies where if this happens, if the let's say for example if the market drops by X percent, we move into this percentage bonds, this percentage cash, this percentage stocks. If market drops by this, we reassess the probability of the next event unfolding. So we appropriate this kind of percentage regarding to this. And so it's very methodical, and all the action happens really right away, right? So some people even have preset, the trades are already preset and ready to go in case a certain event happens. It's gone, right? Computers are playing a larger and larger role into the buying and selling out there. So it's not surprising. Not surprising. But what people like me don't have, we don't have that. I don't have that technology. But what I do have is one big indicator and a couple of edges here. One of the big edges that I think I have is that I'm able to take in information and from other fund managers and big well-known names and economists, and you know um, you can listen to people like you name them, Ray Dalio's or the Hedge Eye guys, or any kind of big investors or the Warren Buffetts of the world, and you can see what they're thinking, and you can kind of gauge it a little bit. You can make a judgment based on how they position themselves already, right? So that's the most important point here, is that um, whatever they think is going to happen, they've already done it, right? They're not going to, everybody out there is going to talk their book, meaning like they've already acted upon what they believe is going to happen in the market, and therefore those trades are already in the market. In other words, it's already priced in. Okay, so if they thought that there was a recession in the market that's going to happen soon, then that's already priced in. If that changes, the market is going to respond almost immediately. And I think that's part of the reason why the volatility has been so strong in the past couple of weeks, is because people are changing their mind rapidly, and the market's reflecting that right away, instead of a more old school type where you would think something's going to happen, you'd mull over the information and then make sure that you make the right move instead of just jumping the gun every 5 seconds. So that's kind of what my opinion is on all this. So I think a lot of this is already priced in. Whatever fact that's known already, it's priced in. The fact that the virus might stick around for such a long time, that's already priced in, right? Elections, that's already priced in. The probabilities, anyways. And as probabilities change, obviously the market's going to reflect that. So there might be some more downturn, and that's why I'm not going bonkers all in 100% bull. But I'm definitely making some bullish bets here, and they might not work out in the short term, but I'm pretty confident by next year we're going to be seeing some newer highs. So, and especially with the fact that I haven't talked about the rate cut, the Fed's rate cut of 50%, 50 basis points. Especially with this rate cut, it's common knowledge now that rate cuts are positive for stocks in the long run, even if whatever loss of confidence people have in the Federal Reserve, the fact remains that interest rates are lower and therefore the valuations of the stocks are affected, right? Stocks return is measured directly to the 10-year yield and short-term rates. So with that in mind, you'll know that a really, really large portion of investors and managers and money movers and fund holders or whatever, that they are judging the market, the stocks they're investing in based on that return rate. So the lower that return rate is, the more attractive the stocks become. And really, even if they think that the markets are overvalued, they're kind of forced, right? They have their hand twisted to invest into it, and they don't really have a choice. And if they're not investing in stocks, they're looking for some kind of yield, right? So they're forced into corporate bonds, and they're forced into higher yielding assets that are a little bit riskier. And so as money, travels up the risk curve, eventually it's going to reach stocks. So everything really gets lifted up and bid up. So the Fed's really pushing people out of the bonds, the safe assets, anything that returns low. Many managers, pension fund managers, etc., all these money managers, sometimes they'll have a mandate. Sorry, I think I may have been blocking my microphone. Some of them have a mandate to return a certain percentage per year. So they'll do whatever they have to do in order to get that percent, even if they know they have to lose principal. Some of the pension managers, especially, because they have to pay out pensions, and so they will take riskier and riskier bets. It used to be commonplace that even people that are retired or near retirement, they have a large portion of their assets into bonds, but because they need yield now and they're no longer chasing appreciation, which is the only thing that bonds are good for nowadays. Because of that, they're actually getting more yield from stocks than the other way around. And this playbook has been in place for quite some time now, where it's a little bit in reverse. You go into bonds in order to gain appreciation, and you go into stocks in order to get yield, which is kind of perverse. So the bottom line is, I think the stocks are going higher. The money printing press is full on, right? Around the world, people are cutting basis points as well, and other central banks in other parts of the world, and other stock markets are feeling it. Some governments are doing direct injections of funds. Like, for example, in China, we had that $71 billion worth of monetary stimulus into the economy, or the markets at least, that hopefully eventually trickles down into the economy. At least that's what their thought is. And because of the virus scare. And so we have all these factors that are just pointing in one direction, into stocks, and that's up. And I did make a video about fundamentals, and that's one of the fundamentals, one of the guiding principles that you want to go into whenever you're investing. Obviously, I'm not a professional. Take my advice with a grain of salt, but I think before you embark on something like long-term investing, have some kind of principles, fundamentals that you want to stick to, and you don't deviate from. And one of the ones that I put for myself is that I'm not going to be more than 55%. I'm not going to be less than 55% along. So I'm always going to be along the markets, at least 55, because if I get it wrong, I'm still gaining, right? I'm not going to be like risk adjusted, of course. Like, even if I have the most bearish scenario, I could be wrong, and I know that the tail wind of central bank and government stimulation, they will not let markets correct very far down for very long. I mean, the mistakes of the 20s and mid-centuries, they've been well understood, the Japan mistakes and everything, so they know what to do, right? They know what to do. They know to inject, and they'll take market gains over any cost, really, including inflation, which we haven't seen in the U.S. that's strong, and we might not, but we've seen it in other parts of the world. Right now, for the last 10 years, the U.S. has been really getting like a safe haven bid, the dollar and the stocks as well. So we're not really seeing it here, but other parts of the world for sure. Currencies are blowing up all over the world. And a lot of the times people don't even realize it, by the way. I have a friend in Australia, and I know how much value his currency is losing, every year, but he doesn't seem to feel it. But when he talks about prices with me, I can see the difference. So anyway, a little bit of tangent, a little off topic there, but basically, I know that the governments and central banks are not going to let the markets correct too far down for too long, right? It's not like we're going to have 2 or 3 years with a 50% bear market. It's just not going to happen. It's probably never going to happen as long as these institutions are in place and functioning the way they are. There has to be a really big change of philosophy or leadership in order for that to happen. So, and I doubt it'll happen. So the dollar is probably going to take the short end of the stick here. All right. I think I've talked enough, 16 minutes already. Hope that gives you a little bit of window of what I'm thinking at this moment. And hopefully y'all are making a lot more money than me. I'm just kind of hanging in there, trying to buy up some assets in this downturn. And I think probably the worst of it is over, even though I'm probably alone in this. I see a lot of the big name talking heads are saying that there's more room far down to go, which emboldens me because they're a good contrarian indicator because of the reason I spoke earlier. Everything they're talking is already priced in. They've already positioned themselves for this, so they're not going to put more money towards it. So the downside, I think, is limited, but who knows? I don't know what's going to happen. Could be wrong, so that's why I have some more cash to put in case I am wrong. Okay, I think with that said, I'm going to leave you all right here. I'll make another video on Monday as usual. And if you watched the video all the way through, let me know by typing in, what should you type in today? No crash. Type in no crash in the comments if you watched this all the way through. All right, with that said, peace out.